For the second straight month, the U.S. Federal Reserve has hiked its benchmark interest rates by 3/4 of a percentage point, the most aggressive monetary tightening in more than a generation.
The move is very much aimed at clamping down on inflation levels unseen in 40 years. And the impact of the decision will be felt beyond just the United States, as countries around the world will also have to follow the Fed's lead, including South Korea, which is expected to maintain its monetary tightening policies. Eum Ji-young starts us off.
The U.S. Federal Reserve raised its benchmark overnight interest rates by 3/4 of a percentage point for a second straight meeting. At the end of its two-day policy meeting on Wednesday, the Federal Open Market Committee announced its largest back-to-back rate increase. The adjustment brings the cumulative June to July raise to 150 basis points, which is the most aggressive tightening since 1981. The short-term borrowing rates now stand between 2.25% and 2.5%, similar to levels in 2019. The decision, despite risking a sharp hit to the economy, was unanimously agreed upon by voting members of the FOMC to crush inflation, which is running at rates unseen in 4 decades.
Our overarching focus is using our tools to bring demand into better balance with supply, in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored.
Powell said that this process is likely to involve a period of below-trend economic growth and some softening in labor market conditions, but added he does not think the U.S. economy is currently in a recession.
There are just too many areas of the economy that are performing, too well. And of course, I would point to the labor market in particular. As I mentioned, it's true that growth is slowing, and for reasons that we understand. Really, the growth was extraordinarily high last year, 5.5%. We would have expected growth to slow.
He also signaled a possible third hike, saying the Fed anticipates that ongoing increases in the target range will be appropriate. The Fed's aggressive monetary tightening also has global repercussions. The U.S. interest rates have surpassed those of South Korea for the first time in 2.5 years, which could lead to capital outflows from South Korea. To prevent this and to curb soaring inflation in the country, the Bank of Korea said it is likely to maintain its monetary tightening policies after taking the so-called big step of a 50 basis point increase earlier this month.
It is desirable to gradually raise interest rates by 25 basis points for a while.
However, an expert says, although it could help stabilize prices, there could be side effects from the big step.
Household and corporate debt have been accumulating since before the COVID-19 pandemic economic crisis. With mounting debt, private spending could go down. Also, it could lead to further polarization of society, as those in low-income groups are likely to be hit harder.
Eum Ji-young, Arirang News.